It's a word that sparks fear in most investors. What if I told you there's a few strategies that you could look at to not only protect your investments, but also come out on top? In today's video, I'm going to share 3 key strategies that you could implement either before or during a recession to make sure you're ready for whatever comes next. Before we delve in, I need to lay out some ground rules before you even think about investing during a recession. The first of which is that you have plenty of emergency savings. You should always aim to have enough money in the bank to cover 3 to 6 months worth of living expenses, with the latter end of the range being ideal. If you're already there and have the extra money at your disposal, feel free to invest it. If not, be sure to build this emergency fund first. The second rule is that you're not planning to touch your portfolio for at least 5 to 7 years. Investing during a recession isn't for the faint-hearted. You may think you're buying at a low, only to see your portfolio decline a few days later. The best way to avoid losses in a recession and come out ahead is to take the long-term approach to investing. So have that clear idea that you plan on leaving your money where it is. The last ground rule here is that you're not going to obsessively check your portfolio. When the economy's in a bad shape, there's lots of stock market movement. You may be more inclined to log into your brokerage account every day and see how your portfolio is doing. But if you're going to invest during a recession, you simply can't do that. The more you check up on your investments, the more likely you are to panic. And when you panic, you're much more likely to sell some of your investments at a loss. Now we've got the foundation set, let's dive into those 3 key strategies. The first and most important strategy is diversification. You've probably heard this advice 100 times, but during a recession, it becomes more critical than ever. Spreading your investments across different asset classes, such as stocks, bonds, and even commodities, can really help you weather the storm. Starting with stocks, during a recession, there's certain sectors that generally perform better than others. This is due to the essential nature of the goods or services that they're providing. Let's have a little look at some of these sectors. First up, we have consumer staples. So these are companies that produce essential goods such as food, beverages and household items. An example of this could be stocks such as Procter & Gamble and Coca-Cola. The second key one is healthcare. So regardless of economic conditions, people still need healthcare, making it a relatively recession-proof sector. And the third one is utilities. Like healthcare, utilities such as your water and electric are necessary. So companies within this sector often maintain stable revenues during recessions. By holding a mix of these assets, you reduce the risk of any single investment losing value. But where does this leave bonds? Let's take the Bloomberg Aggregate Bond Index as our example here. For those who aren't familiar, the Bloomberg AG is a broad index that tracks the performance of US investment-grade bonds. It includes various types of bonds such as government securities, corporate bonds, and mortgage-backed securities. This index serves as a reliable barometer for the overall bond market, and they typically carry lower risk when compared to stocks. So why is this important? Well, if we look at the performance of both this and also the S&P 500 side by side, you can see the green line here, which is the S&P 500, representing the largest 500 companies in the US. Then we have the blue line, which represents the performance of the AG. You can see the dips from the 2008 financial crisis and also the brief COVID-19 recession. While the S&P 500 can provide impressive returns during economic expansions, it can also be highly susceptible to downturns. Stocks tend to react sharply to negative news, leading to more significant price swings. The Bloomberg AG or bonds market, on the other hand, act as a safe haven during the economic downturns. When stocks decline, bonds tend to maintain their value or even appreciate, especially if interest rates are falling. In conclusion then, both stocks and bonds play a crucial role within an investment portfolio. By understanding their differences and how they work, you can better prepare for market downturns. The goal here is to find the perfect balance within your portfolio that not only promotes growth but also stability. So, strategy number 2, so let's talk about dividend-paying stocks. During a recession, companies with a solid balance sheet that also pay a dividend can continue to pay you income even though the stock price may be falling. Dividend-paying stocks, especially those from blue-chip companies, tend to be more stable because they generate consistent cash flows. Even when stock prices are down, the dividend provides a cushion to help ride out the market volatility. Companies such as Coca-Cola, Johnson & Johnson and Procter & Gamble have a strong track record of paying dividends even during tough economic times. Companies like these are what we call dividend aristocrats. Essentially companies that have increased their dividends for at least 25 consecutive years. These companies not only survived but generally thrived during a recession. They continued to pay out these dividends throughout these recessions, which meant that investors still retained some income from their investments. These dividend-paying companies can be a bit of a lifesaver when it comes to something like a recession. It means you're not completely out of pocket and you still have those dividends to rely on. So moving on to the third strategy, and this one might surprise you, but that's in the form of increasing your cash position. While having cash itself doesn't generate great returns, having this cash to one side and readily available can really help you take advantage when stock prices go low. During a recession, prices of stocks generally fall, and you can take advantage of this by buying these stocks at a discount. Chris Davis, the chairman of New York investment management firm Davis Advisors, is often heard quoting this: "You make most of your money in a bear market, you just don't realise it at the time." Chris Davis also conducted a study to illustrate this point. He considered 3 hypothetical investors who had invested $10,000 in an S&P 500 index fund at the 2007 market peak. First, we have the nervous investor, who sold all their stocks following the market downturn at the low of March 9th, 2009 and invested purely into cash. Next we have the patient investor. They held their stocks throughout the market downturn, staying invested. And finally, we have the savvy investor. This is a person who viewed the downturn as an opportunity and invested an additional $10,000 in the stocks at the low of March 9th, 2009. The 3 different reactions led to significant different results. The nervous investor would have ended 2023 with $5,134. The patient investor ended 2023 with $42,206. But incredibly, the savvy investor, who added to their investments during the market low, ended 2023 with $136,547. Now, it's easy with hindsight to look back at the savvy investor's choice and think that was rather obvious, but at the time it probably didn't feel that obvious. At the depth of this recession, all news outlets would have been talking about how things are only going to get worse. Even if you don't invest exactly at the market bottom, there's still long-term growth to be had when you do invest in a market downturn. At the end of the day, investing during a recession is all about discipline and keeping your emotions in check. By sticking to these strategies, whether that's diversifying your portfolio, adding in some dividend-paying stocks, or even increasing your cash position, you're setting yourself up for long-term growth. The key takeaway here is simple. Market downturns are generally temporary, but the decisions you make during that time can set you up for long-term financial success. Stay focused, stay patient, and focus on the long-term goals. If you found this video helpful, don't forget to give it a thumbs up and subscribe for any future content. As always, feel free to drop any questions or thoughts in the comments section. Thank you for watching, and I'll see you in the next one.